I need you to stop what you're doing right now. Close the other tabs, put your phone on, do not disturb, and look at the screen. What you're seeing on the mainstream news tickers, the talk of restoring democracy or counter-narcotics operations in South America, is a carefully constructed smokescreen. It is a narrative designed for the 99% who still believe that geopolitical movements of this magnitude are about ideology. But you are here because you know better. You are here because you understand that in the year 2026, every bomb dropped and every regime toppled is a move on a global chessboard of resource securitization. Specifically, what happened on January 3rd, 2026 in Caracas wasn't just a military strike, it was the opening salvo of a global resource war, and the primary target isn't oil, it's silver. My name is Kevin Huang, and this is Markets in Context. If you want the truth behind the headlines, hit the subscribe button right now because the window of opportunity to position yourself for what's coming is closing in real time. Let's look at the ground truth. At 2 a.m. VET on January 3rd, 2026, the capital city of Caracas was rocked by a series of precision airstrikes. This wasn't a warning shot. Residents reported low-flying aircraft and explosions centered on the Fort Tiuna military complex, the nerve center of the Venezuelan Ministry of Defense, and the La Carlota Air Base. This was Operation Southern Spear, a high-risk decapitation strike executed by the Joint Special Operations Command, or JSOC. We're talking about elite units Delta Force and the 160th Special Operations Aviation Regiment infiltrating the presidential residence while the Venezuelan National Guard was paralyzed by localized electronic warfare. President Nicolas Maduro and First Lady Cilia Flores were captured and extracted via helicopter to the USS Iwo Jima, an amphibious assault ship positioned off the coast. The U.S. administration characterized this as a surgical removal of a criminal regime, citing unsealed indictments for narco-terrorism to provide a legal veneer. But let's look at the timing. This kinetic action represents the most significant U.S. military intervention in Latin America since the 1989 invasion of Panama. Why now? Why this level of risk? The answer lies in a fracturing global order where just-in-time supply chains have been replaced by might-is-right resource acquisition. To understand the silver target, you first have to understand the excuse they used to get through the door, the heavy, crude bottleneck. The mainstream media is fixated on the fact that Venezuela sits on the world's largest energy reserves, but they'll tell you that Venezuelan oil production had already atrophied to roughly 900,000 barrels per day due to years of mismanagement. On paper, the removal of those barrels shouldn't crash the world. But paper isn't reality. The reality is the quality of that crude. Venezuela produces Marais 16, a heavy, sour crude that is absolutely essential for complex refineries in the U.S. Gulf Coast and China's Shandong province. These multi-billion-dollar industrial complexes cannot simply switch to the light, sweet shale oil produced in the Permian Basin. Without Marais 16, the diesel crack spread widens immediately, threatening the very fuel that moves the global economy. When President Trump asserted that the U.S. is in the oil business and would run Venezuela temporarily, he was signaling a strategic shift toward direct resource securitization. Analysts are calling this the Trump corollary to the Monroe Doctrine, a modern, aggressive interpretation that basically states, if a resource is vital to U.S. national security and it's being mismanaged by a hostile regime, the U.S. will take it. But here is where the energy narrative fails and the silver reality begins. Operation Southern Spear didn't happen in a vacuum. It was a kinetic accelerant for a silver market that was already in the throes of a historic supply-side crisis. Just 48 hours before the first bombs fell on Caracas on January 1st, 2026, the People's Republic of China detonated a silent bomb in the global supply chain by implementing aggressive export controls on silver. The confluence of the China shock and the Venezuela shock has fundamentally broken the traditional pricing models for precious metals. For years, silver was the forgotten stepchild of gold. It was traded as a commodity, a secondary asset. But in the opening days of 2026, silver has decoupled from its historic tether to gold. It is now trading as a critical strategic asset essential for both industrial continuity and monetary survival. While the immediate military objectives in Caracas appear to have been achieved with tactical precision, the economic shockwaves are only beginning to be felt. The escalation to this point was calculated. Throughout 2025, the geopolitical temperature rose in a sequence of events that the market chose to ignore. Following the disputed 2024 elections, the return of the Trump administration signaled a departure from diplomatic containment to active encirclement. By November 2025, the deployment of the USS Gerald R. Ford aircraft carrier strike group, accompanied by F-35 stealth fighters to the Caribbean, was publicly justified as a counter-narcotics operation against the Tren de Aragua syndicate. But the market signal was clear. The FAA had issued NOTAMs for Venezuelan airspace, and a naval blockade of oil tankers was ordered, effectively zeroing out exports. The strike on January 3rd was the final piece of the resource denial strategy. By removing the Maduro regime, the U.S. didn't just target oil, they targeted the Arco Minero del Orinoco, a 112,000 square kilometer zone rich in gold, diamonds, coltan, and most importantly, silver. Under the previous regime, this area was a state-sponsored illicit economy, where silver and gold were smuggled to Turkey and the UAE to bypass sanctions. The U.S. strike has disrupted these protection networks, creating an immediate supply freeze that has halted the flow of illicit metal to international black markets. When global markets opened on Monday, January 5th, 2026, the volatility was unlike anything we've seen in the modern era. Brent crude prices rose to the $62 to $65 range, but it was the internal spreads that signaled the real stress. More importantly, silver prices, which had already seen a gamma squeeze in late December due to anticipation of the China ban, surged toward $80 per ounce. You have to understand the psychology of this move. Geopolitical crises often trigger a run on the bank in commodities. When investors see airstrikes on a sovereign nation and the capture of its leadership, they don't look for more paper contracts. They fear counterparty risk. They fear the weaponization of the financial system itself. The Venezuela crisis, following immediately on the heels of the China export ban, has created a double-engine event where industrial demand and monetary demand fire simultaneously. Within Venezuela itself, the collapse of the fiat system has been instantaneous and catastrophic. The Bolivar Soberano has hit a terminal velocity collapse. On the black market, the only market that matters for survival right now, the exchange rate gapped to 560 VEs USD within hours of the strike. With the central bank of Venezuela ceasing to function, pricing has reverted to pure speculation and barter. This is where the survival valuation of silver becomes a reality. In the streets of Caracas, prices for basic necessities like bread or fuel are being quoted exclusively in USD or grams of silver flakes. This isn't just a Venezuelan problem, it's a blueprint for the empire risk that is now being priced into every major currency. Non-aligned nations, the BRICS Plus bloc, are watching the direct military seizure of a sovereign nation and its resources, and they are coming to one conclusion. If the U.S. can seize Venezuela's wealth and leadership by force, no asset held in dollars is truly safe. This is accelerating a trend that was already in motion. Central banks and institutional investors are bypassing fiat entirely for hard assets. As the war premium battles the industrial floor, silver is proving to be more resilient than gold. While gold hit new all-time highs above $4,445 per ounce on the Monday open, driven by the belief that the U.S. would finance the occupation through massive debt expansion, silver is the asset that the industrial giants are panicking over. If you are a manufacturer of solar panels or electric vehicles, you don't care about the debasement trade. You care about the physical metal that is no longer coming out of China and is now locked behind a military blockade in Venezuela. The U.S. intervention is predicated on a transition to a friendly government led by the opposition, with plans for the mass privatization of the mining sector. They want to professionalize extraction and bring in Western majors to dismantle the criminal fiefdoms in the mining arc, but that will take years. In the short term, Venezuelan silver production is effectively offline. This creates a structural deficit that cannot be filled by the remaining global mines, which are already struggling with falling ore grades and a lack of new investment. We are entering a phase of shock reversal and breakout, where the convergence of supply fear from the east and war fear from the south is driving silver to retest its all-time highs. This is not a drill. This is the re-rating of silver as a measure of global instability and industrial necessity. The resource war is no longer a theoretical concept in a white paper. It is a kinetic reality unfolding in the Caribbean. To understand why the resource war has moved from a boardroom theory to a kinetic reality, you have to look at the calendar. While the airstrikes on Fort Tiuna were the visible eruption, the true seismic shift happened 48 hours earlier, on January 1st, 2026. This was the day the People's Republic of China detonated a silent bomb in the global supply chain, and it is the reason why the U.S. military is currently patrolling the streets of Caracas. The China shock was not a military maneuver, but a regulatory decapitation that left the Western industrial complex staring into a void. On the first morning of 2026, the People's Republic of China implemented what analysts are calling a draconian export licensing system for silver. The mechanism, directed by the Ministry of Commerce, or MOFCOM, was designed to act as a geopolitical filter. Under these new rules, only state-approved firms with production capacities exceeding 80 tons and credit lines over $30 million are permitted to export silver. This isn't just a tax or a minor hurdle. It is a soft ban that effectively places a geopolitical gatekeeper between roughly 121 million ounces of annual supply and the global market. You have to realize that China is not just another producer. They are the world's largest refiner of silver and the dominant supplier of the silver paste required for photovoltaic solar panels. By tightening the valve on these exports, Beijing isn't just seeking to raise prices. They are executing a strategic move to secure resources for their own massive solar and electric vehicle manufacturing targets, what they call the Green Leap Forward. This was the ultimate retaliation against U.S. semiconductor sanctions. It signaled to the world that silver is no longer just a commodity used for jewelry or investment coins. It has been re-rated as a strategic critical mineral. This is where the China shock and the Venezuela shock converge into a singular explosive market condition. When MOFCOM locked the gates on 121 million ounces of supply, the Western Hemisphere was suddenly forced to look at its own reserves with a sense of desperate urgency. The United States realized that it could no longer rely on a steady flow of refined silver from the East to balance its internal deficits. It had to secure the Western Hemisphere's largest remaining untapped resources by any means necessary. This is the true context of Operation Southern Spear. The capture of Maduro wasn't just about ending a narco-state. It was about ensuring that the mineral wealth of the Orinoco mining arc, an area of 112,000 square kilometers, rich in gold, diamonds, and critical silver, remained within the U.S. sphere of influence. The reaction from the Eurasian bloc confirms that Beijing and Moscow saw through the U.S. Cohen democracy narrative immediately. Moscow didn't mince words, labeling the JSOC operation an abduction and an act of war. Beijing, which holds billions in Venezuelan debt and has significant investments in the Orinoco mining arc, criticized the cowboy-like conduct and bullying of the U.S. administration. To Beijing, the strike was a direct threat to their own energy and resource security. It confirmed their worst fears, that U.S. foreign policy has shifted from economic containment to kinetic resource denial. This shift has created a paradigm shift in how silver is priced. Historically, silver has been tethered to gold, moving in a predictable ratio. But in the opening days of 2026, we are witnessing a fundamental decoupling. Silver is now trading as a critical strategic asset, essential for industrial continuity. And while gold is rising based on the debasement trade, the expectation that the U.S. will print trillions to fund this new era of intervention, silver is rising because of a physical vacuum. Look at the price progression. In early December 2025, silver was trading around $56, driven by standard Fed rate cut expectations and organic demand from the solar sector. By late December, as rumors of the China export ban began to circulate and the U.S. naval blockade of Venezuela intensified, we saw a gamma squeeze that pushed the price to an all-time high of $84.01 on December 29th. After a brief correction on January 1st, as traders digested the MOFCOM mechanics, the Venezuela strike on January 3rd acted as a shock reversal, setting prices back into the $75 to $78 range. As we hit the first full week of January 2026, we are entering the breakout phase. This is what I call a double engine event, a rare phenomenon where industrial demand and monetary demand fire simultaneously. On one side, you have the industrial giants who are panicking. They see the China ban and the Venezuela blockade and realize their just-in-time supply chains have just been decapitated. On the other side, you have the safe haven flows from investors who are terrified of the escalating resource war between the U.S. and the Eurasian bloc. You have to understand the industrial floor that is now supporting this price. Unlike gold, which is largely held in vaults as a store of value, silver is being consumed at a record pace. The green leap forward in China and the energy transition in the West mean that the need for silver and solar panels is not optional. It is a technological requirement. When you add a war premium on top of this industrial floor, you create a price floor that is incredibly resilient to corrections. Even if the immediate fear of a broader conflict in the Caribbean fades, the structural deficit caused by China's export controls will remain a permanent fixture of the market. The U.S. intervention in Venezuela has effectively securitized the silver market. By removing a hostile regime that was using the nation's mineral wealth to fund an illicit economy, the U.S. is attempting to bring those resources into a regulated, Western-aligned system. But the process of professionalizing the Orinoco mining arc will not happen overnight. Under the Maduro administration, the mining arc was carved up into fiefdoms controlled by military units and criminal syndicates like the ELN and Tren de Aragua. These groups used mercury-intensive, destructive mining practices to extract metal that was then smuggled to Turkey and the UAE to bypass sanctions. The U.S. strike has disrupted these illicit protection networks, but in the short term, it has also frozen the supply. Smugglers have gone to ground, fearing U.S. interdiction assets, and the flow of illicit silver to international black markets has completely halted. This creates a temporary vacuum in the global supply of off-market silver, further tightening the squeeze on refined metal. We are currently in a state of commodity dislocation. The old rules, where you could simply check the spot price on a screen and assume that was the price you would pay for metal, are dead. In Venezuela, this is already a reality. While the NYMEX and COMEX trade paper contracts, the traders in Caracas are dealing with survival valuations, because the Bolivar has hit a terminal velocity collapse gapping from 300 to 560 VES per dollar in a single day. Silver has been elevated to a primary medium of exchange. In this environment, physical silver trades at a massive fear premium. If the global spot price is $75, an ounce in a conflict zone like Caracas might trade for $100 worth of food or fuel. This reflects the utility of silver as an untraceable, indestructible store of wealth that can buy survival when the banking system fails. Paradoxically, we also see a distressed discount, where desperate families liquidate silver jewelry at 50% of spot value just to buy calories from opportunistic buyers with cash dollars. This divergence between the screen price and ground reality is a warning for global investors. The technical structure of the silver market is currently being tested by a run-on-the-bank dynamic. Geopolitical crises incentivize contract holders to stand for physical delivery rather than rolling over their positions, as they fear counterparty risk and the weaponization of the financial system itself. This is hitting a market that was already structurally imbalanced. By late 2025, the ratio of paper silver futures contracts to registered physical inventory on the COMEX had blown out to a staggering 356 to 1. That means for every single ounce of physical silver available for delivery, there are 356 paper claims on that same ounce. The Venezuela crisis has been the catalyst that has forced the market to look at this math. With COMEX inventories already down 70% since 2020, the sudden spike in delivery demands has met a hollowed-out inventory, leading to the violent upside volatility we are seeing, a classic short squeeze driven not by retail traders, but by geopolitical necessity. Investors are now bypassing fiat currency entirely for hard assets. They are watching the U.S. military seize the leadership and resources of a sovereign nation, and they are coming to a realization. Empire risk is real. If the rules of the game can change overnight, if a nation's energy and mineral reserves can be nationalized or seized by force, then no asset held in the dollar-based financial system is truly safe. This is accelerating the trend of central banks, especially in the BRICS Plus bloc, buying physical gold and silver and repatriating it to their own vaults. They are moving into non-sovereign bearer assets as insurance against a world where trust has been replaced by kinetic force. The Caracas. Kinetic has proven that the scramble for resources is the defining feature of the 21st century geopolitical landscape. The perfect storm of the China export ban and Operation Southern Spear has hit the silver market with a regulatory supply shock and a geopolitical demand shock simultaneously. The result is a permanent re-rating of silver as a measure of global instability and industrial survival. We are no longer looking at a standard bull market. We are looking at the birth of a silver supercycle that is being fueled by the atoms required for the future and the bombs being dropped in the present. To truly understand the magnitude of the pressure cooker that just exploded, you have to look past the headlines of special forces and airstrikes and peer into the dark mechanical heart of the global financial system, the COMEX Futures Exchange. What we are witnessing right now is not just a price spike, it is a systemic fracture of the paper silver market. For decades, the price of silver has been dictated by the trading of digital contracts, promises to deliver metal at a future date. But as the smoke rises over Caracas, the world is waking up to a terrifying mathematical reality that the establishment has tried to hide for years. By late 2025, the structural imbalance on the COMEX had reached a terminal point, where the ratio of paper silver to registered physical inventory had blown out to a staggering 356 to 1. Think about that number. Let it sink in. For every single ounce of physical silver sitting in a registered vault, ready for delivery, there are 356 digital claims on that same ounce. In a period of peace and stable supply chains, this hallucination can be maintained through a process of rolling over contracts and cash settlements. But the moment you introduce a shock reversal, like Operation Southern Spear, the psychology changes instantly. Geopolitical crises of this magnitude trigger what is known in the commodity world as a run on the bank. Investors, sovereign wealth funds, and industrial manufacturers stop looking for a cash profit on a screen and start demanding the metal itself. They are standing for physical delivery because they no longer trust the counterparty to fulfill the contract in a world where the rules of the game are being rewritten by kinetic force. This run on the COMEX is hitting a system that was already hollowed out. Since 2020, physical silver inventories in registered vaults have plummeted by 70%. We're not talking about a temporary dip in supply. We're talking about a multi-year industrial drain that has left the vaults near empty. The sudden spike in delivery demands, incentivized by the uncertainty of global logistics and the crumbling rule of law, has met a void. This is the definition of a classic short squeeze, but on a scale that dwarfs the retail frenzy of 2021. This is a short squeeze driven by the survival instincts of the largest players in the global economy. The technical structure of this breakout is unique because it is destroying the traditional correlations that traders have relied on for generations. Historically, when the US dollar strengthens, silver and gold tend to fall, a phenomenon known as the dollar wrecking ball. We saw this clearly during the 2022 Russia-Ukraine crisis, where silver spiked briefly before being crushed by a surging dollar. But 2026 is different. Right now, silver is rising alongside the dollar. This is a rare and ominous signal. It indicates that the fear in the market is no longer just about inflation or interest rates. It is about the weaponization of the financial system itself. When investors see the U.S. move from economic sanctions to the direct military seizure of a sovereign nation's leadership and resources, they realize that empire risk is no longer a fringe theory. It is a reality that makes any fiat-denominated asset, even the dollar itself, vulnerable to overnight policy changes. This is why we're seeing a massive flight to hard assets that exist outside the traditional banking perimeter. Investors are bypassing the digital promises and moving into non-sovereign bearer assets. They want the physical bar in their possession because it carries no counterparty risk. This shift in behavior is what allowed gold to smash through all-time highs, crossing $4,445 per ounce as the Monday markets opened following the strike. The debasement trade is in full swing as the market bets that the U.S. will finance the occupation of Venezuela and the subsequent reconstruction through massive debt expansion, further eroding the purchasing power of the dollar. But silver is the metal that is truly outperforming. While gold moves on the fear of debt, silver is moving on the fear of physical scarcity. Unlike the Hunt brothers' manipulation of 1980, which was a purely financial play based on cornering the market with leverage, the 2026 silver spike is built on a fundamental industrial reality. The shortage is real. It is being driven by the voracious industrial consumption of the East, primarily China's green leap forward, and the sudden geopolitical lockup of Western Hemisphere resources in Venezuela. This decoupling from gold is the most significant development in the precious metals sector in our lifetime. Silver is being re-rated from a precious metal to a strategic technology metal. It is the indispensable atom for the modern world. You cannot build a high-efficiency solar panel, an electric vehicle powertrain, or advanced military electronics without silver. There is no substitute. When China implemented the MOFCOM export licensing system on January 1st, they effectively declared silver a controlled strategic material, much like rare earth elements or advanced semiconductors. This move, 48 hours before the Caracas strike, set the stage for the current explosion because it removed the safety valve of Chinese refined supply from the global market. Now, with the U.S. Navy blockading Venezuelan ports and the JSOC team securing the ground, the war premium is battling the industrial floor. The industrial floor refers to the fact that even if the kinetic conflict in South America were to de-escalate tomorrow, the demand for silver from the renewable energy sector is not optional. It is a structural requirement of the global economy. This dual demand structure warfare on top of industrial necessity makes silver far more resilient to price corrections than gold. In previous cycles, a peace deal might have sent silver prices crashing back to earth. In the 2026 cycle, any dip is likely to be met by a wall of industrial buying from companies that are terrified of their production lines going dark. The empire risk factor is also changing the behavior of the world's central banks. Non-aligned nations, specifically the BRICS plus bloc, are watching the U.S. military action in Caracas with extreme caution. From their perspective, if the U.S. government can decide that a sovereign nation's leadership is criminal and use that as a justification to seize its energy and mineral reserves, then no sovereign asset held in the dollar-based system is truly safe. This is accelerating a trend that was already gaining momentum, the repatriation of physical metal. Central banks are no longer content to leave their gold and silver in vaults in London or New York. They are bringing it home, further draining the available float of physical metal in the Western markets. This leads us to a point of structural commodity dislocation. The price you see on your screen, the $75 or $80 spot price, is becoming an increasingly irrelevant number. It is a paper price for a paper market that is running out of physical metal. Institutional investors are beginning to treat silver as a non-sovereign bearer asset, insurance against the very rules of the global financial system being changed overnight by a tweet or a tactical strike. When you combine the 356 to 1 leverage ratio on the COMEX with the 70% decline in physical inventories, you realize that the silver market is essentially a game of musical chairs where 355 people are about to find out there is no chair for them. The comparison to the 2022 Russia-Ukraine crisis is instructive here. In 2022, the shock was largely about energy and grain. Silver moved because it was a safe haven, but it was ultimately tethered to the broader macro environment. In 2026, silver is the shock. It is the metal at the center of the conflict. By seizing Venezuela, the U.S. is attempting to solve a long-term resource deficit by force, effectively nationalizing a portion of the global silver supply to ensure its own industrial and military survival in the face of the Chinese export ban. But in doing so, they have shattered the trust that the global commodity markets are built on. As we look at the charts, we see a gamma squeeze that started in late December, driven by the anticipation of the China ban and the visible U.S. naval buildup. We saw the price hit an all-time high of $84.01 on December 29th, followed by a brief correction on January 1st, as the market tried to process the MOEFCOM mechanics. But the January 3rd strike acted as a shock reversal. It told the market that this wasn't just a regulatory spat, it was a resource war. The price is now breaking out into a new regime, where $80 is not the ceiling, but the new floor. We are moving into a phase of the cycle where the war premium is being priced into every gram of metal. In a world of fracturing trust and kinetic resource acquisition, tangible assets are the only sanctuary. The paper contracts on the COMEX are beginning to be seen for what they are, digital ghosts of a dying era. The real action is happening on the ground, in the vaults being emptied by central banks, and in the streets of Caracas where silver has already reverted to its ancient role as a primary medium of exchange. The math of the 356 to 1 ratio is finally being forced to reconcile with the physical reality of the vault, and the result is a vertical repricing of the world's most undervalued strategic asset. The era of cheap, paper-suppressed silver is over. We have entered the age of the silver supercycle, and the rules of the game have been written in the smoke of the Caracas kinetic. While the global markets adjust their digital spreadsheets and algorithms react to the flashing red and green numbers on the COMEX, the true reality of the silver supercycle is being written in the streets of Caracas. To understand where the price of silver is going, you have to look at what happens when the veneer of the fiat system is stripped away by kinetic force. In Venezuela right now, silver has undergone a categorical transformation. It is no longer a commodity or an investment asset. It has reverted to its ancient, primal role as a primary medium of exchange. It is the only thing that works when the power grid fails, the banking system freezes, and the local currency hits terminal velocity collapse. The Bolivar Soberano is dead. On January 2, 2026, the official rate was roughly 300 VES per dollar. By the morning of the strike on January 3rd, the black market rate, the only rate that determines if you eat or starve, gapped to 560 VES per dollar. This represents an 85% spread in a single day. With the Central Bank of Venezuela effectively decapitated and unable to inject liquidity or set interest rates, pricing discovery for basic survival has shifted to the survival valuation of hard assets. If you walk into a local market in Caracas today, prices aren't being quoted in bolívares. They are being quoted in two things: USDT, tether, and grams of silver. This is the ground truth of the 2026 crisis. Because the banking system is paralyzed by power outages and the sheer uncertainty of the U.S. administrative oversight, digital payments are failing. Direct barter has become the law of the land. We are receiving confirmed reports of silver flakes, shaved directly from jewelry, coins, or industrial scrap being used to buy bread, fuel, and passage. High-purity bullion like American Eagles or maple leafs have vanished from the market. They are being hoarded by those who can afford them as lifeboats. What's left is scrap silver cutlery and jewelry being traded at a fear premium that would make a Wall Street trader's head spin. Look at the math of this localized distortion. While the global spot price might be $75 an ounce, the fear premium in a conflict zone like Caracas can push the effective trade value to $100 or more when exchanged for essential goods. This premium reflects silver's utility as an untraceable, indestructible store of wealth that can bribe a guard or buy a seat on a transport out of the country. Paradoxically, we are also seeing the distress discount, where desperate families are forced to liquidate their family heirlooms at 50% of the spot price just to secure immediate calories from opportunistic buyers with cash dollars. This divergence, where silver is simultaneously the most valuable and most undervalued asset, depending on who is holding it, is a preview of the global commodity dislocation that is coming for the rest of the world. The ultimate prize in this kinetic resource war, however, isn't the jewelry in Caracas. It is the Arco Minero del Orinoco. This is a 112,000 square kilometer zone larger than many European nations that is arguably the richest mineral deposit on the planet. Under the Maduro administration, this area was a state-sponsored illicit economy, a black hole where the military and criminal syndicates like the ELN and Tren de Aragua operated with total impunity. They used mercury-intensive, environmentally devastating mining practices to extract gold and silver, which was then laundered through Turkey and the UAE to keep the regime's inner circle afloat. Operation Southern Spear has decapitated that protection network. The Special Forces teams that secured the capital have effectively frozen the logistics of the mining arc. Smugglers and illegal miners have gone to ground, terrified of the U.S. interdiction assets and drones now patrolling the Orinoco. This has created an immediate global supply freeze. The illicit metal that used to find its way into the global gray market is now trapped. This isn't just a Venezuelan problem. It is a massive subtraction from the global aggregate supply that the COMEX and LBMA never accounted for. The U.S. administration is banking on the Plan País, or country plan, developed by the opposition and Maria Corina Machado. The goal is mass privatization, dismantling the criminal fiefdoms, and bringing in Western mining majors like Barrick and Newmont to professionalize extraction. They want to turn the mining arc into a transparent, Western-aligned resource hub that can counter China's dominance. But here's the catch that the soft landing crowd is missing. This transition will take years, not months. The infrastructure in the mining arc has been destroyed by years of neglect and predatory mining. There are massive legal liabilities from previous expropriations, cases like Crystal X that must be settled before a major public company will put a single drill in the ground. In the short term for the rest of 2026 and well into 2027, Venezuelan silver production is effectively offline. This means the Venezuela shock is not a temporary blip. It is a multi-year supply-side decapitation that coincides perfectly with the China export ban. We are entering the shock phase of Q1 2026, where the combination of the China licenses and the Caracas kinetic will drive silver to retest its all-time highs between $78 and $85 per ounce. As we move into the medium term, even if a friendly government stabilizes Caracas and the war premium begins to fade, silver will not return to its old prices. The industrial floor has been permanently raised. The structural deficit caused by China's solar demand, their green leap forward, and their refusal to export refined metal has put a hard floor under the price at $65 to $75. Any new supply from a professionalized Venezuela is at least 3 to 5 years away, and that's if everything goes perfectly. The long-term outlook for 2030 is even more explosive. The geological reality is that we are running out of high-grade silver. Ore grades are falling globally, and there has been a chronic lack of investment in new primary silver mines for over a decade. It takes 7 to 10 years to bring a new mine from discovery to production. This means the silver deficit is structural and permanent. We are looking at a secular bull market where $100 silver is not a moonshot, but an inevitability as the metal is re-rated as a strategic technology metal. For the people of Venezuela, the path forward is arduous. As the economy eventually dollarizes and stabilizes under a new administration, the local premiums and discounts will eventually vanish, and their silver will once again trade at global spot prices. But for the global investor, the lesson of January 3rd, 2026 is clear. The U.S. military intervention in Venezuela was a watershed moment, a kinetic manifestation of the scramble for resources that defines our century. By attempting to secure the Western Hemisphere's largest energy and mineral reserves, the U.S. has unleashed a Pandora's box of market volatility. The silver market has been hit by a perfect storm, a regulatory supply shock from the East, and a geopolitical demand shock from the South. The result is a paradigm shift. Silver is no longer just a metal. It is a measure of global instability. It is the canary in the coal mine for the death of trust in the financial system. Whether it is the silver flake held in the hand of a trader in Caracas or the futures contract on the NYMEX, the story is the same. In a world of fracturing empires and kinetic resource denial, tangible assets are the only sanctuary left. The Caracas kinetic was the signal. The silver supercycle is the result. If you aren't positioned now, you are waiting for a train that has already left the station at 2 a.m. VET on January 3rd. My name is Kevin Huang, and this is Markets in Context. This analysis is built on ground truth and hard data, not the narratives the mainstream wants you to believe. We are living through the most significant repricing of strategic assets in modern history, and we are going to be here every step of the way to break it down. If you value this level of deep dive research and want to stay ahead of the next resource shock, hit the subscribe button right now and turn on notifications. The era of cheap resources is over. The era of markets. In Context is just beginning. Stay sharp.